For instance, the highest earners in Singapore will have to pay more in personal income tax from the year of assessment 2024. Resident taxpayers' chargeable income in excess of $500,000 to up to $1 million will be taxed at 23%. Income in excess of $1 million will be taxed at 24%, and this is up from the current 22% tax levied on income in excess of $320,000. Well, this increase in the top marginal personal income tax is expected to raise $170 million of additional tax revenue each year. Well, property tax is currently Singapore's principal means of taxing wealth. Property tax rates for both owner-occupied and non-owner-occupied residential properties will be raised in 2 steps, starting with the tax payable in 2023. Tax rates for owner-occupied homes with an annual value of in excess of $30,000 will be raised, ranging from 6 to 32%. This compares to 4 to 16% for such homes today. And tax rates for non-owner-occupied homes will be increased to 12% to 36%. The increase will be more significant for properties with a higher annual value. All right, Vikram, we have to get your take on this as well. Let's just talk about the property tax for now. To what extent will the higher property tax rates help to cool down the very hot property market?
I'm not sure about that, because if you remember, it took 10 rounds of cooling measures from 2009 to cool the property market. It took 10 rounds of them. And this is not a capital gains tax or property gains tax. This is a higher property tax. So it's a tax on owning property, basically, right? And I think, and it's more focused on the high end. I think the high-end owners of property can afford to pay this tax, but it will have obviously some impact, especially at the high end. But I think if you want to really cool the property market, I think the much more powerful impact will come from higher interest rates.
Okay.
Yeah.
Well, property tax, personal income tax, and there's also a tax on luxury cars. So taking these different forms of taxation for the wealthy in totality, Vikram, would it discourage foreign investors from coming to Singapore? And consequently, will it make Singapore less competitive?
I don't think the tax regime will have much of an impact on Singapore's competitiveness. I mean, look at all the taxes. Look at the GST. It's still very low by global standards, even by Asian standards, for countries that have GST at 9%. The OECD average is 19+%, okay? Then the property tax is very targeted, basically at the high end. It doesn't apply to the majority of the population. Corporate tax is moderate, even with, it's already moderate at 17% headline rate. And the effective corporate tax for a lot of SMEs is in the single digits. Personal taxes, despite the increase, are still quite low, and that's the increase only applies to it's a millionaire's tax, basically, right? So it doesn't apply to most people.
Yep.
And in any case, most Singaporeans don't pay any income tax, right? So I think what matters much more than tax is things like rule of law, safety, political stability, predictable regulation. These are the things that really count for investors to invest in Singapore. I don't think tax issues are so important in their minds.